Hello, my name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Today, we're going to have a special program talking about reverse mortgages. You know, reverse mortgages are an outstanding option for enticing retirement or for enhancing retirement for senior homeowners. Yet, even today, they continue to be feared and misunderstood by many homeowners. And yes, I know there's a tremendous amount of information about reverse mortgages out there, online, social media, and so forth. But after many years in the mortgage industry, I continue to be amazed about how many senior homeowners I encounter who continue to hold onto myths and misinformation about the loan product. And that's unfortunate because I've encountered many instances where the reverse mortgage product can be a tremendous financial tool that would benefit a senior homeowner once they understand the program. So with this presentation, I will provide my contribution to the topic of reverse mortgages and explain why I think they are and I explain what I think are the key elements to grasp. And I'll do so in plain and simple terms so every viewer can grasp the concepts and benefits of this truly unique and beneficial program for the senior homeowner. I will focus on the core reverse mortgage product originated in the United States, the home equity conversion mortgage, also known as a HECM. What is not well known or understood is that this is actually an FHA, that's Federal Housing Administration program. That's important to know because this is part of the reason the HECM reverse mortgage program offers so many benefits to the senior homeowner. So what is a HECM reverse mortgage? It's surprising to find that some people think getting a reverse mortgage means the bank will own my home. That's not true. The lender will have a security interest in your home because your home serves as collateral for the loan, just like the traditional forward mortgage you may have obtained to initially purchase your home. You didn't think the bank owned your home then, did you? A reverse mortgage is no different. With either a reverse or a traditional forward mortgage, you do have certain obligations to avoid default that could trigger the foreclosure process by the lender where they could take your home. But that's not the same as the bank owning your home. The key point to grasp is that a reverse mortgage provides you flexibility of not making a monthly payment, unless you want to and you can. More on this payment flexibility later. So next, who is eligible for a HECM reverse mortgage? Note that for multiple borrowers, typically a married couple, one borrower can be under 62 years of age. That's the eligibility threshold, but it will affect the amount of the loan that's possible. Allowing a spouse under 62 to be a homeowner was a major enhancement that eliminated past scenarios where the younger spouse would be forced out of the home when the older spouse who was eligible for the loan passed away. But also note that your age that is closer to but higher than the minimum of 62 for eligibility will generally require much more than 50% equity to avoid a mortgage payoff shortfall. There's also going to be a financial assessment. It's primarily focused on the homeowner having the residual income and/or financial assets to maintain property-related expenses such as property taxes, homeowners insurance, HOA dues where applicable, maintenance, and repairs. So what goals do a HECM reverse mortgage accomplish for a senior homeowner? What does it align to their goals, or how does it align to the senior homeowner's goals? Well, you can see from this list, it clearly demonstrates that a majority of senior homeowners want to stay in their home, remain independent and financially secure to enjoy retirement comfortably. Note how low on the list leaving money for their heirs is. This underscores that a reverse mortgage is primarily for the benefit of the senior homeowner while they're still living and enjoying their home, something that their heirs are sometimes not always aligned with. It's well known that oftentimes a senior homeowner may have owned their home for years to the point it's free and clear of a mortgage, but they may lack the monthly income and/or the financial assets needed to achieve many of the goals listed above, particularly the ones at the top of the list. Their home is an asset, but can't provide the funds needed to achieve the goals above without the tool of a reverse mortgage that allows them to access those funds. Now, next, what I want to mention is flexibility. A reverse mortgage provides flexibility. Most senior homeowners think a reverse mortgage means not making payments, and oftentimes, if not a majority of times, that is true. but that's an option, not a requirement. Yes, if you don't make payments, the loan balance will grow because the interest due is added to the balance. That's something called negative amortization. But if you have the ability to make payments on the loan, you are free to do so as often and as you like and in varying amounts. Doing so will result in your loan balance growing more slowly versus not making payments at all. But in addition to mortgage payment flexibility, reverse mortgages also provide flexibility in another way, and that is access to funds. Not only does a HECM reverse mortgage provide payment flexibility, the access flexibility can include multiple options, the most common one being, the most popular one being, a line of credit, or LOC. Much like a HELOC or a home equity line of credit, the LOC allows the senior homeowner to access funds in an amount and at times when most needed. The interest expense is only based on the amount drawn. There is no interest expense on the undrawn portion. And most importantly, the undrawn balance of the LOC, the line of credit, grows over time, providing the borrower access to more funds later. The senior homeowner can also set up monthly payments to be dispersed to them either for a specific term, such as 10, 15, or 20 years, or for their lifetime. That's called 10-year payments. Drawing a lump sum is also an option, but is limited to a max of 60% of the available loan amount in the first year. When taking this max amount, the borrower loses the ability to access any of the remaining loan amount. So lump sum access is usually for a smaller amount than the max when borrowers are getting that or taking that option. Lastly, it's sometimes the case the borrower will use a combination of these options, such as a modest lump sum at close, combined with a term payment schedule and a line of credit. Talk about flexibility. I mean, what more could you ask? Now, the other thing that reverse mortgage does is it provides you leverage in regards to how you use the funds. As you can see from this list, there are many possible uses to leverage the funds from a reverse mortgage beyond just eliminating a mortgage payment. A senior homeowner may be relatively financially secure, but sees an opportunity to use reverse mortgage proceeds to make investments. Or they can use a reverse mortgage program as a strategic tool to preserve their financial assets when they are drawing from them for living expenses. And they can protect that strategy from sequence of returns risk. Now, that's a complicated issue. We can provide a presentation to your financial advisor to help explain to you that strategy. And consider gifting early inheritance. Rather than your family inheriting your home equity when you pass, wouldn't it be much more rewarding to provide some of that equity earlier to allow you to observe how it can help them improve their lives? A reverse mortgage can also be a great way to finance the cost of retrofitting your home to better meet health and wellness needs, or to finance home care. And of course, don't forget the option of using a reverse mortgage to build an ADU. You can rent that out for additional income, or you can use it, have it be used by family members. Maybe get that 35-year-old off the couch and into their own living space on your property, but separate from where your main house is. Now, the next thing to understand about reverse mortgages is what kind of reverse mortgage types are there? Well, it's pretty simple. A reverse mortgage offers a fixed or adjustable rate option. The fixed option is less popular because it offers lower available loan amount and starting rate will be higher than the adjustable rate option. The adjustable option is the most popular due to the higher loan amount available, lower starting interest rate, and offers the possibility of the rate dropping when rates are trending downward. Plus, there's the 5% life cap, which is considered good protection in periods of rising interest rates. We often get asked, how is the reverse mortgage loan amount calculated? Well, unlike a traditional forward mortgage, there is no LTV grid, that's loan to value. There is no loan to value grid for available loan amount based on things like property type, property disposition, owner occupied, second home, investment property, credit score, and so on. Instead, your available loan amount is based on the property value and the age of the youngest borrower. Think in terms of the higher my property value and my age, the higher the possible loan amount available. If married, a younger spouse, particularly under 62, will significantly reduce the available loan amount. But this also protects the younger spouse from having to vacate the home when the older spouse passes. Now, reverse mortgages and mortgage insurance. This is probably the mortgage insurance is probably the most misunderstood and underappreciated part of the reverse mortgage loan. It is considered to be quite expensive. However, consider this: the cost is similar to a traditional FHA forward mortgage, one of the most popular mortgage programs in U.S. history, but it provides a non-recourse provision that provides ultimate protection to the homeowner and their heirs, so they will never be required to pay the deficient balance if the loan amount rises above the home value. This makes the cost of mortgage insurance worth every penny. I mean, by a lot. That's an important and substantial benefit, well worth the cost of the reverse mortgage. Now, what about closing costs on a reverse mortgage and mandatory obligations? The closing costs will include, of course, the mortgage insurance we just talked about and other costs that are typical with any mortgage. Certain items must be paid at close as shown and are deducted from the principal limit. Think of principal limit as your gross loan amount. And then you arrive at your remaining principal limit after deducting closing costs and the mandatory obligation. Consider that your net loan amount. The remaining principal limit is the net amount available to the homeowner. And note, we will originate a HECM adjustable rate loan with no origination fee to the borrower, because otherwise, many originators will attempt to charge you as much as a $6,000 origination fee for a HECM adjustable rate mortgage. We don't do that. Now, a fixed rate HECM reverse mortgage will have an origination fee. We do not control that. That would be charged to you by the lender. So finally, to close, I want to, in addition to the HECM reverse mortgage we just talked about, I also want to point out to you that we have other reverse mortgages. So it's time to think outside of the box. And here you can see a couple programs we have. We have, and with these other programs, they provide the senior homeowner with financing options tailored for their individual situation to optimize their retirement goals. Call us today and we'll provide a free proposal and consultation to assist you with the best option available to suit your needs and enhance your retirement goals. So thank you for watching and listening to our reverse mortgage presentation. My name is Art Alvarez with Mortgage Works. If I can be of help in any way with this loan program or any other, feel free to reach out to me. Take care. See you soon. Bye.